Good morning, or I guess afternoon now, everybody. I hope everyone is doing good. We're so glad you are here with us today. All right, give everybody a chance to kind of get in here so we can get started. All right, so if you have never been to one of these before, let me introduce myself. My name is Sarah Lorenzen, and I am an outreach specialist and certified financial education instructor with the Oklahoma College Assistance Program. Two programs that we have: Oklahoma Money Matters, which is all about financial literacy, and Ready, Set, Repay, which is all about student loans, which is kind of my bread and butter and the topic of today's webinar. If you've never attended one of our Make It Count webinars before, you know that this webinar is on the third Tuesday of every month. We choose a different financial topic every month that we find is going to be relevant to you. And we do it, we record it so you can go back and see it later. We just want to make sure that you guys are getting all of the financial information you need to make the best possible decisions. So that said, I always like to know who is here with me because there is a lot of different folks that join us for these. So I just launched a quick poll. If you would take just a second to go in and answer that poll and let us know where you're coming from. And if you don't see any of the options that fit you, go ahead in the chat and tell us where you're from, because I would definitely love to know. I see a lot of college staff, some high school counselors. Awesome. Awesome. Couple college students. I'm glad to see you guys here. All right. Fantastic. All right. Looks like everybody has answered. Got a great mix of folks here. I'm so glad that you are here with us today. So let me go ahead and get started. If you've been on one of these before, you know that there are always some norms that just kind of make this go really well for me and for you guys. I am going to ask that you stay muted. Not that I don't want you to be interactive. I do want you to talk to me in that chat, ask your questions, have conversation, make statements if you need to. Just please do it on mute because we are recording this, and I want to make sure that anyone who hears this after today can hear it as clearly as possible. But do make sure that we're being respectful to others. I feel like that should go without saying, but when it comes to money, especially student loans, it tends to be a hot button topic. So we just want to make sure that we're setting that expectation. I also want to stress that while I am a certified financial education instructor, I am not a financial coach or a financial counselor. So this is not financial advice. This is just financial education to help you make the best decisions you can. And then a special caveat to today's edition: all of the information that is in here is accurate as of June 18th, 2024. Why is that important? Because if you've been watching the news at all lately, you know that things with student loans are changing a lot and have been for the last several years. So it is very possible that the things I say today could change tomorrow. So I would definitely encourage you to watch the news and to, get alerts from the Department of Education to keep yourself up to date on kind of what is going on. So a little agenda about what the things we're going to talk about today. We're going to talk very briefly about the different types of loans that you might have. We're going to talk about some of your repayment options. We're going to talk about what you need to do today if you just graduated and are getting ready to repay your loans, or if you had to withdraw, you're getting ready to repay your loans. What do you need to make sure that you do so you can successfully repay your loans? We're also going to talk a little bit about some of the options you have with student loans, so you know what these terms mean and how they affect your loans. So when it comes to having to maybe make those decisions in the future, you know what your options are and how you can make the best decision for yourself. So we're going to talk about deferment and forbearance. We're going to talk a little bit about income-driven repayment plans. I'm going to talk a little bit about the difference between refinance and consolidation, because a lot of times those two words are used interchangeably, but they're actually two different things when it comes to student loans. And we're going to talk about what to do if you are struggling to repay, because it happens sometimes. You get laid off from a job, somebody gets sick. So we want to know what to do there. We're also going to talk about some few red flags to keep an eye out for when it comes to scams that sometimes can happen when it comes to student loan repayment or student debt relief or some thing like that is what you may hear it under. And then we're going to talk a little bit about forgiveness programs and public service loan forgiveness, just the basics, so you kind of know what your options are if that is something you're trying to seek out. All right, so let's get started because we got a lot to cover in this hour. So our first thing that we're going to cover is we need to know the difference between federal loans and private loans. And this is important because depending on which loan you have, which most people have federal loans, they act a little bit differently, and the options you have with them are a little different. So with federal loans, your repayment starts when you either leave school or you drop below half-time enrollment. So that is below 6 hours a semester. Whether that is you withdrew or you just go down to taking only one class, that'd be considered dropping below half-time enrollment. You will have a fixed interest rate. Those rates are set every year by the Department of Education. Sometimes they're a little higher, sometimes they're a little lower. But it is a fixed rate for the life of that loan. So as long as you have that loan, your interest rate should stay the same on that loan, regardless of what the economy is doing. Generally, they do not require a credit check except for plus loans, which I'll talk about what that is here in just a minute. There are several repayment options and benefits, things like deferment or forbearance that can help prevent default if you start having trouble paying your loans back. As well as federal loans, most of them, or now the active ones, are eligible for federal forgiveness and cancellation programs. And I'll talk a little bit more about that here in a second too. And then there are private loans. Private loans generally come from a bank. Sometimes they can come actually from your institution, but their terms are set solely by the person who is lending the money, whether that is the bank or that is your institution itself that is lending you that money. These may require payment while you're in school. Think of this just like an auto loan or a mortgage. They don't generally give a grace period before you have to start paying those back. They can have variable interest rates, and they may be higher than federal loans. They may also require you to have established credit or to have a cosigner. They very rarely have flexible repayment options now. Some borrowers do, but if you have private loans, I highly suggest getting with whoever your lender is and make sure that you have all of the information we're going to talk about, that you find out what those things are for your private loans. And private loans also aren't eligible for any federal forgiveness or cancellation programs. So things like federal deferment or public service loan forgiveness are not things that are built into the private loans. Now, there are some options that you can get built in. For example, if you were to become disabled, sometimes they will allow you to write into that loan that there is a disability forgiveness option if you can prove that you are disabled and can't repay. But that doesn't come standard with every loan, and that depends on the lender. So it's really important to make sure that you read the fine print and understand before you take one out or before you start repaying, you understand what you're looking at. Okay, so let's talk about the different types of federal loans. And since the majority of people who borrow loans have federal loans, I'm going to go really in depth into this. So the first one you will see, especially if you just graduated from undergraduate, is you're going to see a direct subsidized loan. This is what's called a need-based loan. So the FAFSA told the financial aid office that you would need this loan to be able to pay for school based on the financial information that the FAFSA gave them. And it is only for undergraduate students who have the financial need. The Department of Education pays the interest on this loan while you're in school. The way I always like to explain this is if you took out $1,000 in a subsidized loan your first semester of freshman year, 4 years later, when you graduate as a senior with your bachelor's degree, you are going to not have accumulated any interest to that point. So when you start repaying, the interest will start to accrue, but only on that $1,000 because that $1,000 hasn't gained any additional interest while you were in school. Whereas the next type is called a direct unsubsidized loan. This is what's called a non-need-based loan, meaning that even if the FAFSA didn't say you needed this Generally, most students will qualify for this. And it is for undergraduate and graduate students. And the borrower is responsible for all of the interest on the loan, and that is from the time it is dispersed. So let's look at that same example. If you took out $1,000 in an unsubsidized loan the first semester of your freshman year, interest would accumulate on it from the moment you got that money dispersed from financial aid to the bursar to pay your loan balance, all the way until you start repaying, and then it will continue in repayment. And at the end, it does what's called capitalizing, which it gets added to your initial principal balance if you haven't been paying it while you're in school. And you don't have to pay it while you're in school, but if you do, and I can talk about that more here in a little bit, it can sometimes help to reduce the overall balance you end up paying. But in that same $1,000, we'll say in that 4-year period, you accumulated $700 in interest on that loan. So whenever you graduate and you start repaying, that $700 is going to become $1,700. And then you're going to start accumulating additional interest on top of that $1,700 and have to pay from there. And that's an important differentiation, because if you were to go into a deferment for some reason, your subsidized loans do not accumulate interest when they are in a deferment for like school, or if you have some reason like you're sick or unemployed or something like that, and you're in a deferment, that does not accumulate interest. But your unsubsidized loans accumulate interest regardless of the status of your loan. And that's important to keep in mind. The next are direct plus loans. This is another non-need-based loan, and there's 2 different types. There is one for parents. It's called a parent plus loan. And this is for parents of dependent undergraduate students. So this is something that if you are a college student, your parent would take out in their name to help pay for your education. That's a really important differentiation, because there's a very common misconception that I hear all the time when I'm talking to people about student loans, where they have taken out a Parent Plus loan and they said, oh, I'm just going to go ahead and transfer that loan to my child when they graduate with their degree. Well, the problem is that is taken with your parents' credit, your parents' name, and it has to stay in their name until it is paid off. So if you and your parents work out something to where you are paying for the loan every month, great. But if you stop paying on that loan, then it doesn't hurt your credit, it would hurt your parents' credit. So that's really important to understand. Then there's graduate loans. So if any of you are either going to grad school or getting ready to go to grad school, you would understand that these plus loans, they do require a credit check. It is the only federal loan that requires a credit check. But it functions very much like an unsubsidized loan. From the moment it is dispersed to you or to the school on your behalf, it accumulates interest, and you are responsible as the borrower for paying all of it. All right. Now, the reason I talk about these 2 is because a lot of times I have students who had been going to school at one point previously, and they maybe stopped out for a while and then came back. So I want to make sure that I talk just briefly about these 2 types of loans. These 2 types I'm talking about are no longer offered, meaning you cannot get a new one of these loans. But if you had been in school prior to the date that these programs ended, it is possible that you may have one. So it's important to understand the types of loans that you have. So a Perkins loan was a low-interest federal student loan for undergraduate and graduate students who had exceptional financial need. This means the FAFSA told them a lot, that they needed a lot of help in order to complete school. The borrower didn't pay interest while they were enrolled in school, just like a subsidized loan. But this loan is not eligible for forgiveness programs like public service loan forgiveness. Now, and I'll talk about this more here in a second, there is a loan forgiveness, or excuse me, a loan cancellation program for Perkins loans that is very specific. You have to go into certain types of careers in order to get these forgiven. But this program ended in 2017, so they are no longer offering these loans, but you may still see them out there if you are dealing with student loan borrowers for those college staff that I have on the call. And then there are an older loan type, which is called a federal family education loan. You may see these called FEL or FELP for Federal Family Education Loan Program. This program ended in 2010, but it went back as far as student loans go, back into the 60s and 70s in some areas. It is a program that worked with private lenders to provide education loans that were guaranteed by the government. So while these are technically a federal loan, they actually operate a lot like a private loan. So they are not eligible for forgiveness programs like public service loan forgiveness. And I know you guys have probably heard a lot about that in the news recently. So, and they did have all of the different types of loans, the subsidized, unsubsidized, and plus loans were available through this FEL program. And there are definitely still some out here. I know up until a few years ago where I consolidated all my loans together, I actually had about 50% of my student loan balance was in these federal family education or FEL loans. So they are definitely still out there. All right. Before I move on, does anybody have any questions? I am jumping over to the chat. It doesn't look like I've got any questions at the moment. Okay. Okay, Jacqueline, you said, so some of the loan programs come and go. How often does this happen? This actually doesn't happen very often. So the FEL program was around for decades. And it was guaranteed generally by the states. Actually, the Oklahoma College Assistance Program, or OCAP, that I work for, we actually started as what was called the Oklahoma Guaranteed Student Loan Program. And so up until 2010, when that program went away, we were one of the guarantors for the state of Oklahoma for those loans. Now, that being said, generally the loan programs don't just go away. The direct loans have been here since 2010. There is no indication that they're going to be leaving anytime soon, because what happened was in 2010, President Obama centralized everything to where all of the student loans, instead of it being managed by these different guarantee agencies, now they are all managed by the federal government and federal student aid, also known as the FAFSA people. So now they are all managed in one place by the Department of Education. So I highly, in my personal opinion, all right, I'll stress that in my personal opinion, I don't think that there's going to be a time where this program is going to go away. And if it does, it's not going to be for a long time. All right, we're going to go ahead and move on because we got a lot of stuff to cover. So if you just graduated or you are getting ready to graduate, what you need to do, you need to make sure that you are going to studentaid.gov. This is also the place where you filed your FAFSA. You're going to want to sign in with your FSA ID, which is the ID you use to file your FAFSA. And then you're going to want to make sure that your contact information is up to date. This is really important, especially if you were living on campus and now you're not. You need to make sure that there's updated contact information, especially if you start falling behind on loans or things like that. They need to be able to get a hold of you. You're definitely going to want to confirm who your servicer is. There are a few, they are contracted through the federal government. If you ever want to know if a servicer, like you get contacted by someone, you can tell. And also you can look them up on studentaid.gov. You can actually just search, contracted servicers, approved servicers, and it will bring up the information. So you can see which servicers are actually handling federal student loans with approval of the government. But what you'll want to do is confirm who your servicer is. And I can show you here in a little bit how that you'll see that at studentaid.gov. Make sure you set up your account with your servicer. This will be where you go to pay. This is who you'll contact if you start having trouble making payments for some reason. This is also where you'll go to do a lot of things as far as the management of your student loans. If you're going to do auto pay, where it automatically just pulls that payment out of your account every month, you're going to want to confirm all your details, make sure that you have everything set up. And you're also going to want to go in and estimate your monthly payments. You're going to want to evaluate the repayment plan options that are there. And if you find one that works best for your budget and your financial situation, then you're going to want to apply for it. And you'll do all that through studentaid.gov. And sit tight. I have some more information on that particular piece here in just a little bit. But you're also going to want to take whatever that estimated amount is and create a monthly budget and start getting used to that payment being gone while you are in your grace period. Take that payment, put it into savings. Why? Because then you have a little bit of an emergency fund saved up. So you have money in case there's an emergency. So you can take that money and the money you have and use it towards paying off those student loans as fast as possible. But it also makes sure that you don't have to take on additional debt while you are trying to pay off your student loans. And it's just good to get used to the payment being gone, because I can tell you from experience, when you have 6 months where you don't have to pay these loans back and all of a sudden you have to find that money in your budget, especially if you have what's called lifestyle inflation. You know, you are in your what I like to jokingly call your big kid job. You are doing what you need to do, and your lifestyle is matching it. Maybe you got a new car, maybe you got a new apartment. That lifestyle inflation takes money away from your budget. And so it's important to make sure that you are still building that payment in, so you know what that amount is going to be. So in 6 months, you're not scrambling to figure out how you're going to afford this student loan payment, along with all of these things that have changed since you graduated from school. All right, so let's talk about repayment plans. I know several of you that I saw on the call have attended this particular one when we do it every year. So you're going to notice that this has changed some. And this may actually change further, depending on some stuff that's going on in Washington right now. But there are, as of July 1st, going to be 7 repayment plans. There used to be 8. But these are the 3 that you see the most often. There is the standard. That is, when you take out your student loan, they say you're going to make payments for 10 years, pay that back. That is generally for everyone that takes out a student loan, the plan that they are put on first. And that is, you know, the amount divided by 120 payments, and that is the amount that you pay. The next is graduated. This allows you to make smaller payments in the beginning, because hypothetically, as that 10 years progresses, you're going to be making more money. So you'll have a smaller payment in the beginning and a larger payment at the end. You may end up paying more in interest when you do it this way, because there is more for the interest to calculate on, because you're doing the smaller payments in the beginning. And then there's extended. This is generally for people who have more than $30,000 worth of debt. Generally, if you go to somewhere like law school, or you become a doctor, you go to med school, generally this is the loan that they are put on, where it gives you 25 years to pay that back. You can do fixed payments or graduated payments depending on your financial situation. But you will pay more over time, because instead of paying it off in 10 years, you're paying it off in 25. And so that's 25 years more of sitting through and, you know, interest accumulating on your balance. And then there are 4 income-driven repayment plans, right? There is SAVE, which a lot of people have heard about, and I'll talk a little bit more in detail about here in a minute. Income-based repayment and income contingent repayment. And then there is one specifically for folks who have those FFEL loans still, called income sensitive repayment. And I'll talk a little bit more about them. So with SAVE, they have a lot of different things, and I'm going to wait until I talk about these other 3 to talk about SAVE, so I can talk about it in a little more detail. So income-based repayment requires you to have a high debt to income ratio. It is based on your annual income. So they will calculate 10 to 15% of your discretionary income, and that will be your payment. So instead of it being based on the amount you've borrowed, it's based on your discretionary income. Something to keep in mind with this is that your spouse's income and your spouse's loan debt may be included in the calculation if you are married. So it's really important to make sure that you talk to a tax professional if you are married and you're working on student loan repayment, to make sure that you're making the best decision for your situation. They will forgive whatever balance remains after 20 to 25 years of payments. That 20 to 25 years depends on when you took those loans out. But that forgiveness is taxable. Currently, until 2025, President Biden has made it to where it is not taxable, except for a handful of states that do not follow the federal tax code when it comes to that. But going forward, if that is not extended, it will be taxable to get forgiveness through one of these income-driven plans. And there's income contingent repayment, or ICR, which is 20% of your discretionary income, and basically the same concept. Your spouse's information is included. It is forgiven after 25 years, but that forgiveness is taxable. All right, so let's talk a little bit more about SAVE. So SAVE is the newest. It replaced the old plan called Repay. And as those of you who've been on here notice that there used to be another plan called Pay, and that plan is actually going away as of July 1st. So this Saving on a Valuable Education, or SAVE plan, it replaced Repay. What it did was it raised the income protection, which read that as $0 payments, up to people who make 225% of the current federal poverty limit. There's a whole chart for that, so please don't ask me what that amount is, because I'll have to look it up. It will save most current borrowers at least $1,000 a year because of the way that it's calculated, because it is calculated 5% of your income on your undergraduate loans would be your payment, 10% of your income on graduate loans. And then if you are like me and you have undergraduate and graduate loans, they would do kind of a weighted average around both, depending on how many of each you have. Unlike the other plans where your balance, you may see your balance increase because you're not covering all of the interest that's accumulating on your loan. With SAVE, any interest above your payment, as long as your payment is made on time, will not calculate on top of your loan. So everyone's like, oh, that's so great, no interest will accumulate. Well, do remember that then you would have to go through a separate thing to pay onto the principal of that loan, because you can't just make extra payments on SAVE, because any payment you make is going to be going to principal, or going to be going to interest. If you are married and filing separately, in this one, you do not have to include your spouse's income, which is really kind of a groundbreaking thing. And the biggest change with it is that if you have less than $12,000 in loans, your loans can be forgiven in as little as 10 years. And then it would add 1 year for every $1,000 that you have in loans, up to a maximum of 25 years. So if you have larger balances, you're still kind of where you were. But if you have a lower balance, it makes it a little bit easier for you. Okay, so let's talk about how you figure all that stuff out for yourself. So once you have gone into studentaid.gov and you have looked at all of your information, right? You'll see this when you sign in, and it'll show your aid. It's going to show your loan balances. It's going to show any grants that you had. Over here on the right-hand side, you'll see where it shows upcoming payments, and it also shows who your servicer is, and it'll give you a link to your servicer site, so you can go straight in and get all of that information set up. But in order to find if a repayment plan, like an income-driven plan, works best for you, you're going to go to this quick links and go to Loan Simulator. And what it's going to do is it's going to take you to a page that looks similar to this. You're going to say, I want to find the best loan repayment strategy, and you just hit Guide Me. Now, if you were in different circumstances, like you're currently struggling, you lost your job, you're currently struggling with money, they do have another option for that. But this is just if you want to find a plan that works best for you, you'll select this best strategy. So what it's going to do is it's going to ask you a bunch of questions. It's going to ask you to answer all of these things and select any of them that apply to you, and it will ask you more questions depending on what you've answered. The more you give them, the more accurate it will be. It's going to ask for your filing status, what state you live in. It's going to ask for your yearly salary and if you expect that income to grow any. It's also going to ask you if you want to be considered for public service loan forgiveness. And so you have the option to kind of toggle that on and off. Now, when we did this particular one, it says that currently pay as you earn, which until the beginning of July, so just a few weeks from now, this plan is still an option. In this scenario, for this person, it recommended that pay was going to be the best repayment plan for them based on what they had put in. But you can go in and you can change your repayment goal. If you say, I want to pay it off the fastest, or I want a low monthly payment, if I want to pay the lowest amount total over time, what does that look like? If I have a certain date I want to get my student loans paid off by, what is the plan that can get me there the fastest? And it also lets you toggle on and off the public service loan forgiveness option. So if you are considering pursuing PSLF, it lets you kind of see what your options are also. The thing I like the most is that just because it recommends a specific repayment plan does not mean that you can't go and look for yourself and compare those plans. So as you see here, this is kind of an extended version of it, and it shows some of these different options of what people are looking at for this particular scenario that we put in here. So you can actually go in and look for these. All right, let's talk a little bit more about consolidation and refinance. These are used so interchangeably. Consolidation is only for federal loans. It combines all of your student loans, your federal student loans, into one repayable loan to the Department of Education. So it has to be federal loans. It can be federal family education loans, Perkins loans, as well as the direct loans can all be consolidated together. But they have to be federal loans in order to be consolidated. The new consolidation loan, it has to be done under one of the income-driven repayment plans. And it's not for everyone because it can affect the total interest cost that you pay over time, the terms of your repayment agreement. And depending on kind of what you're looking at in your situation, it can also change your loan forgiveness options. But it can make those older loans like your FFEL loans or your Perkins loans eligible for things like public service loan forgiveness if you weren't eligible previously. When you refinance your loan, it takes all of your loans, federal loans and private loans, and it combines them into one repayable private loan. That is a really important differentiation. It is also based on yours or a cosigner's credit score. So it may not be the best option if you don't have great credit. It may have a really, really high interest rate. So you may actually not be saving money by doing a refinance versus a consolidation. Terms and conditions vary widely by lender. So you really need to get in and compare the fine print if you're considering doing that. And because it is taking all of your loans to a federal loan, if any of those federal loans were in your refinance, those loans will lose any eligibility for all of those federal forgiveness and discharge programs. So you'd no longer have access to deferment or forbearance or the income-driven repayment plans or public service loan forgiveness or any of those other forgiveness programs. And for some people, that is a great situation. They can pay those loans off easy and it's no big deal. But for others, that definitely is not the best case scenario. So make sure that you're reading all of the fine print and really looking at your financial situation before you decide to do that. Okay, some pros and cons. With consolidation, it can change the repayment term, so it can make it shorter or longer, depending on what you're wanting to do. It helps simplify, right? If you're making a payment, it's a lot easier to make a payment to principal on 2 loans versus many. It makes your money go further when you're making your payments. So that can definitely be helpful. It can make loans who didn't previously qualify for public service loan forgiveness, which can definitely help people if they're wanting to try to get their loans forgiven. It also is a way for people who have defaulted on their loans to rehabilitate their loans by consolidating those defaulted loans into a new active loan and bringing them back to good standing. Some cons, it does not reduce the overall cost of your loan because you're still having to pay that full amount. It can reset the clock on any forgiveness programs. So if you've already been working in a nonprofit or government or something like that, for example, and you're working towards public service loan forgiveness, this may actually make it harder, because if you will lose any of that time prior to consolidation that you may have worked. You can still work the 10 years after, but that's important to keep in mind. And you will also lose the remainder of your grace period. So if you are 2 months into your grace period and you decide that you're going to consolidate, you're going to have to start repaying likely on month 3 instead of having that additional 4 months of time to kind of sit and get ready for repayment. And once you've done it, you cannot undo it. So it is important to keep that in mind too. While it is not necessarily a bad thing, you do need to be very careful to make sure that this is the best choice for your financial situation because you can't undo it once it's done. Some pros and cons of refinance. Depending on your credit, this can actually make your loan have a lower interest rate. It does streamline the loans to where it can take all of your federal and private and make them into one private loan, which is just one loan payment, which can be a lot easier to keep track of and a lot easier to pay ahead on, because it's all in one spot. It can change the repayment terms. So you can actually pay it off in a shorter period of time or a longer period of time, depending on your options. Some cons, interest rate can be higher, not only because of what the economy is doing, but at that time, but also based on your credit or the credit of someone else who's co-signing with you. You will lose all federal forgiveness options. So no more options for public service loan forgiveness or anything of that nature. You will lose federal death and disability discharge. Now, I mentioned earlier that some of the lenders do have where you can build into the contract for your loan, where if something was to happen to you, that amount can be discharged. But it does not come standard generally. So it's important to make sure that you're looking into that because while none of us want to think about getting so hurt we can't work or passing away unexpectedly, you definitely want to consider not passing that balance down to your family, especially if you have a very large one. Because federal loans, if something happens to you and you cannot repay them because you pass away unexpectedly, that balance can be forgiven, to where your family is not responsible for that amount. Whereas the private loans don't necessarily go away if something happens to you. And you'll also lose federal forgiveness, federal deferment and forbearance options. Okay, so for the sake of time, I'm going to jump over and I will stay on a little bit longer if we need to for questions, but I want to make sure I get all of this information covered because there's a lot of it. So when repayment is a struggle, the first thing you need to do is contact your servicer. They are a lot easier to work with if you are proactive and reach out to them first, than if you wait until you are delinquent. What is delinquency? It starts on the first payment. It means that you are behind on your payments. It starts the very first day of the missed payment. So, if your payment is due on the 1st and it is the 3rd and you have not paid it, you're already a couple of days delinquent. Depending on your servicer, at a certain point, they will report that to the credit bureaus. So it will end up hurting your credit, depending on how long it lasts. Now, some servicers have a grace period of, 10 or 15 days from your due date where you can still pay it without it technically being late to where they will report it. But you really need to speak to them at the first sign of trouble, because if you get into too much trouble, you then lose options like deferment or forbearance that could help prevent you from defaulting on your loan. Okay, so let's talk about default. So you do not want to default on your student loans. You cannot bankrupt student loans, and you definitely don't want to default on them because there is a lot of negative things that can happen. Loans are considered default after 270 days of not paying your loan or failure to repay your loan according to the terms that are in your MPN, without submitting requests for deferment or cancellation on time. What I mean by that is your master promissory note outlines, which is the contract you signed when you took out your student loan. It says these are the terms in which you will repay your loan. And if you haven't reached out to your servicer to say, get on an income-driven repayment plan, and you just stop making payments, or you start making payments for a lower amount, that can still be considered failure to repay your loan according to the MPN terms. So it is important to make sure that you don't do that, because what happens with default, they can garnish your wages. They start taking your state and federal income tax refunds. It will damage your credit, and it doesn't go away after a few years. It will stay on there until you fix it. You will then also lose options for deferment or forbearance, and any future financial aid. So if you're trying to go back to grad school at some point and you default on your undergraduate loans, you won't be able to get financial aid until you get your loans back in good standing. So it's important to make sure that you don't mess that up and that you talk to them. So we talked a lot about deferment and forbearance. I've mentioned it several times. What is it? Well, they are essentially the same thing, but they have a couple pretty significant differences. So deferment is a approved pause that you get for a reason. There are a bunch of reasons, but a few examples are: you are in school, you are undergoing cancer treatment, you are having an economic hardship, such as you are unemployed and cannot find gainful employment, even though you've been trying. Um, the difference here is that when you're in deferment, any of your subsidized loans temporarily stop accumulating interest while you are in deferment. Then there is forbearance. Forbearance is also an approved pause. And if you don't qualify for a deferment, generally your servicer can put you in a forbearance for a period of time to help prevent you from defaulting. Even if you maybe don't qualify for economic hardship for some reason, but you tell them, I'm still having economic hardship, even though I didn't get approved, they can then put you in a forbearance. But all of your loans, your subsidized and your unsubsidized loans, will continue to accumulate interest while you are in a forbearance. And if you don't pay that interest that's accumulating, whenever you come back into your payment status, all of that interest that accumulates is going to capitalize on top of your loan. So it's going to make your loan balance increase. So it is a great option when you are having financial problems or things like that. I've used it myself. I got laid off from a job about 5 or 6 years ago. And the first phone call I made was to my student loan servicer and said, here's what's going on. I'm not sure when I'm going to be able to find a job again. I need something in order to not default on my loans. And they were able to put me in a forbearance for a few months. So that is a very good option. You also have the option in this circumstance to try to get on an income-driven repayment plan if you're not already, to see if that can help make your payments more manageable. All right, if you have defaulted on your loan, you do have a couple of options to fix it. You have, at one time, you will have what's called loan rehabilitation, which is you talk to your servicer and you agree to make 9 on-time full monthly payments within a 10 consecutive month period that are voluntary. It's not the money that they take out from your state or federal tax or from your wages. And it is an approved amount that you and your servicer has agreed to. And then what they mean by on time is that you make it within 20 days of your due date is their grace period that they give you. And once you've successfully completed that, it brings your loans back into good standing. They stop doing any collections on your account. But you can only do this once. So once you've done it, if you fall into default again, you no longer have this option. Your only other option then would be to consolidate your loans into a new loan to bring that loan into good standing and hopefully get that loan onto an income-driven repayment plan and make it a little bit easier to pay. So it is definitely a great option, but it can be kind of a headache. So I highly recommend preventing it if you can. All right, so let's talk about some red flags. I hate having to talk about this, but if there is something to deal with money, there is generally some red flags somewhere because someone is going to try to make money off of it. So, some things to keep in mind. Anything that requires an upfront payment or a monthly fee, right? Back when I first got out of school, it was when President Obama was in office, and I saw all over Facebook there was these advertisements that said, oh, President Obama student loan for, cancellation program, things like that. And if you clicked on it, it asked for a bunch of your information. And it was a scam. It wasn't actually a thing that was happening. So anything that requires you to sign over a power of attorney or a third-party authorization to allow them to talk to federal student aid on your behalf. Anything that requests your borrower's FSA ID or password, probably a scam. They will never ask for your FSA ID and password. Anything that requires you to give them credit or debit card information in order to qualify for that forgiveness or cancellation or consolidation or whatever, it's probably not a good option. Anything that uses high pressure sales or time sensitive sales practices, like you have to do this right now or something bad is going to happen. Generally, that's a scam. Anything that dissuades you as the borrower from contacting your servicer. There has been plenty of times that I have seen friends who have gotten contacted by, oh, well, I paid this fee and they took care of my student loans for me. I didn't even have to talk to the government about it. That is not that's not a legit thing. So be wary of that if you see that somewhere. Anything that promises immediate debt reduction, forgiveness, or cancellation. This is important to keep in mind because while there are forgiveness programs out there and there are cancellation programs out there, uh, none of them are fast, right? Even things like public service loan forgiveness, which is a legitimate program. I have friends I know who I have seen their student loans be forgiven through this program. So it is a legitimate program. It takes 10 years, right? And you have to be working for a certain type of employer. You have steps that you have to jump through. So it is possible to get forgiveness, but anything that promises immediate relief is probably not legit because that just doesn't work that way. And then be leery of anyone who touts their relationship with the Department of Education. Even the servicers who are approved and contracted with the Department of Education, other than a little logo on their website, generally don't brag about being having a relationship with the Department of Education. And remember what I said earlier, you can always go to the federal student aid website or studentaid.gov, and you can go in and you can check and make sure that they are actually a servicer that works with them. They do have that information out on studentaid.gov that you can fairly easily find it. They've got a little search bar that you can put that in. So make sure that you are being careful and looking for those things. Okay, so let's talk a little bit briefly about forgiveness and cancellation programs because we've been talking about it a lot. So forgiveness and cancellation are things that you will no longer have to make payments due to your job, right? You are a teacher, you get teacher loan forgiveness. You are a public service loan forgiveness. You go through all of your things, you match up, and then you submit all of your paperwork and they forgive your loans to where they will discharge it and you no longer have to pay those. Same thing with Perkins loan cancellation. They have their own loan program where you can go and do the things that, are outlined within the program. And if you successfully complete those, they will cancel your loans. But then they also have discharge programs that are available. Things like total permanent disability. If you get injured or you become sick to the point where you cannot work and in the future look like you will not be able to work again, you can apply for total and permanent disability. Your loans can be discharged to make sure that your family is not having to pay your balance if something happens to you. And there are a lot of other discharges in place to help prevent fraud or to rectify fraud that may have happened on the base of a school, or maybe someone didn't send your money back. Like if you took out a $5,000 loan, decided you only needed 2,000 of it, and you went back to your financial aid office and said, I need this loan, this money given back to the federal government. I don't need this money. And for some reason they didn't process the refund and you can prove it. You can potentially get your loans discharged. So those are some other options that are available. There are also a lot more on readysetrepay.org, which I have on an end of a slide, that are from a bunch of different things. There's other forgiveness programs there, especially if you are someone who's going into the medical field. There's quite a few. All right, so let me talk some about PSLF because I always get questions about it, and I want to make sure that you have the basic information. So in order to qualify for public service loan forgiveness, you have to have direct loans. They can only be direct loans. They cannot be those other loans that we discussed, or a consolidation loan that qualified that got those other loans put into a direct loan. You have to work full-time for the government, any level, federal, state, local, tribal, work in public education, work for a nonprofit that has a 501c3 status, work for AmeriCorps or the Peace Corps, any of that time period. You have to have done 120 qualifying payments on those federal loans that are in good standing on an income-driven repayment plan, which I'll show you the slide and remind you what those are here in a second. That has to have been made after October of 2007. It has to have been on a qualifying repayment plan. It has to have been for the full amount that was due at the time. So whatever your payment was on your income-driven repayment plan, it can't be late. So it has to be no later than 15 days beyond your initial due date. You cannot be in deferment or forbearance at the time that you certify. So if you were in school and you're in school deferment, so you're not paying for your loans currently, but you work for a nonprofit, that time period is not going to count because you are currently still in school. And these don't have to be consecutive. I've been working towards public service loan forgiveness myself for several years now, and I have 2 years that qualified, and then I actually left nonprofit for a while. I went to for-profit for about 5 years, and then I came back to working in for-profit and government, and I was able to still get both periods counted because it is based on your payments, not necessarily that they are consecutive payments, as long as they are qualifying payments and at the time you meet all of this requirement. Okay, so steps to take once you are in repayment. Go and use the PSLF help tool. You'll find that in that little link, quick links section of studentaid.gov, and it will help walk you through. You'll need your EIN number, which is the tax ID number for your employer. And you'll need that information. It will tell you if it's a qualifying employer. It will double check if you are on the right repayment plans. It will double check if you have the right loan types. And if you don't, then it'll give you options to change those things. And then you will go and you will get your employer to sign off either manually or virtually. They've got a digital option to sign off on your employment. And you're going to resubmit that every 6 to 12 months for the entire time period. And what this does is every 6 to 12 months, they go through and they confirm that you meet all of those requirements, and it puts like a little tag in their system on your payment to make sure that that is one of your payments that counts. And then once you've hit your 120th payment, you go back through that process again, but you submit the option that says, yes, I have completed 120 payments, and they will review it. It does take a little bit of time, but once you get forgiveness, they will send you a letter confirming your forgiveness, and they will wipe out your loans. Or if for some reason you're not approved, they will send you a letter saying why you haven't been approved for it. If you're approved and you've paid money over the 120th payment, they'll refund that money to you. And if you're denied for some reason, they'll tell you why, and they give you a 90-day period in order to contest that decision and to try to remedy it so you can work on getting that forgiveness taken. Now, as of July 1st, when pay goes away, these are going to be the 3 repayment plans that will count. So save, income-based repayment, and income contingent repayment are the repayment plans. You have to be on one of the 3 and meet all of those other requirements to qualify for public service loan forgiveness. So that is important to know. Okay. And this, of course, is studentaid.gov. And this is a little screenshot of what that looks like, just so you can kind of see what the help tool looks like. After you fill it all out, it will either print this out for you, where you can print out a PDF and then print this and physically have someone sign it and submit it, or where you can virtually have them sign it via email. But this is kind of what that form looks like. All right. I'm going to go ahead and leave these resources up for a moment and click back over to the meeting. Oh, what is my computer doing right now? Okay, sorry. Give me 1 second, y'all. I'll get back to those resources for you. All right. There's those resources for you. If you have any questions, please put them in the chat. I would be happy to answer them for you while I am here. I'll give you guys a second if you are typing. And then here is my contact information. So if you have any questions or concerns later, maybe there's something you didn't want to ask in front of the entire group, you definitely can email me afterwards. And I am happy to do that for you. While we're kind of waiting, I'm going to go ahead and stop the recording here, and that way I can answer your questions.